Since 2007, Amazon has historically grown sales per share very consistently at a rate of 25.04%. More importantly, historically, when you put the weekly closing prices on the graph, their stock prices traded around 2.5 times sales. When it got expensive, like it did in 2018, that led to a period of a year and a half or more of flat performance. Then the stock rallied during COVID when people were shopping more online. It got way overvalued relative to its sales and kind of languished for the next year and a half or so, and then recently has come back into attractive territory. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. I want to once again welcome you to a subscriber request Tuesday video where you guys ask for me to cover certain stocks and I try to accommodate you. Very importantly, as I go through these, I want you to recognize, number one is, since you asked for so many stocks, and I really appreciate that, I'm obviously not able to get into great detail on each of them. And, I will do other videos where I will do comprehensive analysis of a given stock, one that, I have chosen, for example. But these are stocks that you've asked to see, so I'm going to show them to you. Now, this last week, I've got over 30 stocks in the portfolio that you've asked to see, so I'm going to go through them very, very quickly. I'm going to just hit some highlights on them. One of the things I want you to focus on, and one of the beauties of the Fast Graphs Fundamentals Analyzer software tool that I'll be utilizing to do this for you, is you can see how the business has performed and then how the market has historically priced that performance. But then you can also look at forward and see what analysts are currently thinking about, the stocks. And if you're a Fast Graph subscriber, you can also input your own data. So the tool gives you the ability to, check fundamentals relative to valuations and, be able to make what I call prudent buy, sell, and hold decisions. So I'm going to go over these stocks very quickly. Some of them I wouldn't buy, I wouldn't invest in, they don't suit me, but yet they could be interesting speculations. There's a lot of different reasons why you might want to own a stock. So I'm going to go through the ones that you've asked to see here very quickly, and I'll try to kind of, give you some insights as I do that. So let's start out here with the very first choice would be Alcoa. And I'm doing these in alphabetical order. So you can see now the first thing that strikes you when you look at a company like Alcoa is how cyclical the stock is. The orange line is plotting earnings per share. The white line is dividends per share. And you can see earnings have gone all over the place. So have dividends, where they've raised them and cut them. And then if you look at stock price, notice how closely it tracks all that very inconsistent performance. This is not the kind of stock that I personally, like to invest in. You could call it a speculation now based on what analysts expect, the growth to be this year. The stock could be a short-term speculative trade. But as a long-term hold, I think stocks like Alcoa with a cyclical nature can be very, very detrimental to your overall results, because clearly going all the way back, looking at this portfolio going all the way back to January 4th, 2002, you actually had a negative growth, 10,000 shrunk to 7,900. You got a little bit of inconsistent dividend, and you literally had a negative compound growth rate. By the way, for those of you who have commented that you don't like this new format for our performance, you'll be happy to know that we are giving you the option where you can expand these numbers or not, and that's coming. That'll be an upgrade to the site that we're going to be launching very quickly, so your performance results will be a little easier to use, but you'll still be able to look at the quarterly detail if you choose, or you can look at it annually. Anyway, that's Alcoa. That's one that I'm personally not very fond of investing in. I would consider this a trading stock. I like to tell an old joke about sardines, where I buy a can of sardines for 50 cents. I sell it to my friend for 75 cents. He then sells it to his friend for $1. And then his friend has to call him and tell him, he was hungry. So he opened the sardines to eat them, and he discovered they were rotten. So he called his friends to tell him, "Hey, you rascal, you sold me a rotten can of sardines." And the friend had to inform him that, there are two kinds of sardines. There's eaten sardines and trading sardines. What I call an eaten sardine is a company who grows their business every year, grows their dividend every year if they pay one, and is a good long-term investment. A very cyclical stock into, an aluminum company like this, a metal stock, they tend to be very, very cyclical, very, very hard to forecast, and they're not really the kind of stock that you can necessarily buy and hold for long periods of time. You have to be able to get them when they're really inexpensive. And you literally have to do what Warren Buffett said, be greedy when others are fearful and fearful when others are greedy. But that's very hard to do with cyclical names like Alcoa, even though the statistics look good. This is an agricultural farm machinery company, Agco. It's also somewhat cyclical, paid a very small dividend, started in 2013. They raised the dividend dramatically in 2001. You can see that. And then, they're back to a more normalized dividend. This must have been a special dividend a couple of years that they paid. Again, I don't follow all these stocks, so I don't know them. This stock looks inexpensive. It could be a long-term buy and hold stock if you're looking for capital appreciation. That's where the real allure would be on Agco. But it's not one that I'm real familiar with, but the stock does look very inexpensive today. So that's something you might want to look at. Amazon, I kind of covered in the intro here. If you look at Amazon from an earnings point of view, it's really been not really performing that well for the last couple of years. But as I pointed out in the introduction, if you look at it from a standpoint of price to sales, if you look at it from a standpoint of operating cash flow, Amazon looks like it's, once again, a very attractive growth stock. And it is a growth stock, pays no dividend. And, you're buying this strictly, speculating on the long-term growth of Amazon, but it does look attractive today. Artisan Partners Asset Management. I'm not really familiar with this stock either. I don't really understand these high payout ratios. So if I went and look at it with operating cash flow, at least it looks like their cash flow is covering their dividend. The yield is 11.51%. That's very high. There's no real forecast, so I'm going to go ahead and go down to EBITDA. Again, one of the advantages of a tool like this, you can look at the company from a lot of different prospects. From a standpoint of EBITDA, the stock looks inexpensive today. It's also the price drop is justified by the fact that EBITDA is expected to be weak this year. But again, you've got 11.5% dividend yield. The dividend record is somewhat spotty, I might point out, but they've consistently paid a dividend since they've been paying one. But you can see how the stock came out, the price got real high, and then it's pretty much tracked its, EBITDA in this case, or its operating results very, very closely. Price to sales has also been a good metric for this company. It looks reasonably attractive today. It did get pretty expensive. It got up to like 3 times sales. It normally trades at less than 2 times sales, and that's about where it's trading at today, 1.69 times sales. So there's one that, you might want to take a look at if you're looking for income. But again, beware of the inconsistency of a company like this. The beauty is you can see what that looks like, and these high payout ratios of earnings aren't as troublesome if you look at it from cash flow, etc. Academy Sports, relatively, new opportunity here. The numbers don't make a great deal of sense. The earnings growth is real high. The stock has only been trading at 5 times earnings. So if I'm looking at it from a standpoint of its normal multiple, it does only offer about 5% growth and doesn't necessarily look real attractive at 5 times earnings. But then if you looked at it from a more normal 15 PE ratio, which a stock like this might command, it looks like a screaming buy. So this is one that you'd have to use your own judgment on. Again, you can always use the Fast Graph tool and go into the company's website and see what they do. And so it's obviously a retailer. They're selling products like this online, and whether it's attractive or not, I'll let you be the judge of that. The next stock we want to look at is BHP, and this is another diversified metals and mining company here. And once again, you see a relatively cyclical nature, very erratic dividend. The stock, the fundamentals look okay. The PE is only 8. The yield is 10.39. Earnings yield is very high. The stock is A-rated, but keep in mind that the dividends and even the stock price and the operating results are very unpredictable. If you're investing in something like this, you need to be aware of the nature of the beast, so to speak. I think that's critically important. Caretrust is a REIT. As such, you want to look at it from a standpoint of FFO, or funds from operations. I'm going to look at it going back to the beginning of 2016. It's been about a 7% grower. Price has tracked that very nicely. It's currently looks slightly undervalued based on forecast growth. It's offering over a 6.75% dividend yield. It's got an FFO yield of 8.49%. This would certainly be one. It's a small cap, 1.5 billion market cap. This is one that I might be interested in taking a closer look at if you're looking for a good income vehicle. Anyway, that's Caretrust. The next one I'm going to look at is Camping World. Camping World is obviously a retailer. So far, it's been, really had some rough operating results, somewhat inconsistent. The dividend has been all over the place. It does offer a real high yield right now, a very, very low valuation, and an earnings yield of of astronomical, of over 24%. But I really don't know how much you can trust, the results of this company. If you go into the analyst scorecard for its short history, the analysts miss this, quite a bit. So Camping World is, because of the dividend cuts and the erratic operating results, is not the kind of thing that I'm really looking for. But if you're a speculator, the stock certainly looks extremely cheap today. Deere & Company has been a very interesting, it's a quasi-cyclical, I call it, with infrastructure build out and so on. It's really, had a couple of good years, and the stock price, you can see, reacted to that. Going forward, the stock looks like it could grow at 13 or 14%. That puts it on the high side of valuation. When you're looking at these stocks like this, you can learn a great deal from reviewing the past about what the company's like. It's got a really solid dividend record, but it is cyclical, and you need to be aware of that. But you're only going to be investing in the future, so you want to be looking at valuations into the future. And the market did like to put a premium valuation on this over the last 4 or 5 years. That's what you're seeing here. Okay, but it's got about an 18 or 19 normal PE ratio because the growth rate has been exceptionally strong. But that's not necessarily the growth that the company would have normally achieved. If you bring out, use the tool and bring out, some of the stuff, you'll see this has been about an 18 or 19% grower. Terrific company. By the way, I really like this stock a lot. I'm actually long on it in certain accounts. I haven't been buying it since it got a little pricey, but it's, it doesn't have much of a dividend yield, but it's got a great long-term track record for growth. So that's what Deere & Company looks like. It does look inexpensive relative to its historical growth, and it looks a little expensive relative to its future growth. So that should be taken into consideration when you're analyzing Deere. Dell Technologies, we obviously know it's technology, hardware, storage, and peripherals. It's had really tremendous growth, but the market's only been valuing this at around a 10 multiple. So if I'm looking at, the future, if I look at the normal multiple of around 10 or 11 times earnings, it does look inexpensive, does offer the potential for a 2.5 or 3% dividend yield. This might be a great time to be looking at Dell and doing some research to figure out what kind of stock it is. Etsy is a classic example of these high-flying growth stocks that, by the way, had some tremendous numbers. I want you to understand something when you're analyzing a stock like this. The pictures look interesting, obviously, and they are accurate, but you also have to look at the numbers associated with what's going on with these stocks. Growth rate in 2020, earnings growth was 254%, and then it slowed down to 26%, and now it's expected to have a negative growth this year. And, of course, that can explain where the confidence of the company really changed. And it goes from being an extremely high flyer at almost 87 times earnings to currently a still high flyer at 29 times earnings. And, forecast growth is double digit, but, looking at it from a standpoint of a normal PE of 63 times earnings, that would be a hard stretch for me to say this company's worth 63 times earnings if it's only going to grow at 14 or 15%. So this might be one that I even wait. The possibility of it dropping even further to me would be very real. Freeport McMoran, again, it's another, company in the metals industry, copper. So I've had 3 or 4 of them here, 2 or 3 at least that I've shown you. Again, the natures of this beast, it's a very cyclical industry. Dividends are, they cut them, they eliminate them at times, they reduce them at times. Very, very unpredictable, very, very hard to analyze a stock like this and be able to have any confidence in what the future might be. So I tend to stay away from it, even though statistically at a 12 PE and an earnings yield of 8.5%, it looks good. But the problem is, what can I, count on for this company in the future? So that's Freeport McMoran. That's what business looks like historically. Fastly, I'm not really familiar with this one, but it's an internet service company. I think it has something to do with speeding up your internet usage. I'm really not, again, real familiar. I've never done any research on this stock, but it hasn't really earned any money. The thing about a stock like this that you might want to look at would be the sales. The sales growth has been strong. It's normally trades at around 15 or 16 times sales, but I'm really not sure that a company deserves that kind of a high evaluation times sales. That's a pretty big stretch. So again, I'm using this tool to analyze what I'm seeing and what I'm looking at. I'm not just looking at the picture and saying, oh, it looks cheap based on sales. The price to sales number here is very, very high, and you want to be taking that into consideration when you examine them. Here's a global medical REIT. I'm not really sure what was going on back here. I'd want to shorten that time frame. It looks like a decent REIT at about 5.8% yield. It does look a little pricey. Currently that's based on sales, based on operating cash flow or FFO. It looks like it's reasonably priced, not excessively cheap and not excessively expensive at the same time. So that's one that you might want to take a closer look at. Innovative industrial properties. Here I'm looking at operating cash flow. This apparently is another REIT. It's an industrial REIT. Does offer almost a 5% yield. It was very, very expensive. It's now become what I'll call moderately expensive or fully valued, not really cheap, not really expensive. It's just trading at full value, but it does offer a lot of growth potential. If you're looking for growth and income, this could be a great choice, depending on what your research would uncover. LTC Properties here. It's another healthcare REIT. There's been some issues after COVID with these healthcare REITs. I don't really like the lack of consistency of this one compared to some of the others. Does offer currently almost a 7% yield. The payout ratio has gotten dangerously high here recently based on FFO. And then, of course, even if you used FFO and based it on FFO, it does look reasonable here. But again, understand what the company's historical results have looked like when you're analyzing the stock and put that information into the equation. Malibu Boats, I've covered this as a growth stock in the past. I think it's still a growth stock. I think the stock is very, very inexpensive. It normally trades at about a 15 multiple. That's the blue line on the graph. So, currently, if you're looking at it at about a 14 or 15% growth rate, that would indicate some very high rates of return. The normal multiple, as I said, is around, 14 or 15. This stock looks extremely cheap based on, the fact that its fundamentals look real strong. No dividend. It's pure growth. So, Malibu Boats is a recreational company, obviously. Leisure products, you might want to take a revisit of that one. Here's Magna International. Auto parts and equipment. This has been a really tough industry lately because of what's been going on with, COVID and parts, and the used car market's hot. Automobiles have been really crazy, but this stock does look extremely cheap, offers almost a 3% yield, earnings yield of 8.37%, blended PE of just under 12, and that would make it look very inexpensive based on what its expected future growth is. From a normal multiple of only 10, it still looks like very attractive, but it would look more fully valued on that basis. So again, always take all these things into consideration. Don't settle on one metric. Don't settle on one time frame. Run multiple time frames so that you get a good perspective of what to expect, and then always make your investment decisions on what you think the future is going to look like and what valuation the market is liable to value the stock at in the future. Use your common sense. McCormick, Spice Company, is just ridiculously overvalued in my opinion. This is one of my favorite companies on the planet. I love the consistency. If you take price off of this stock and things related to price, like the normal PE ratio, you can't ask for a better picture. Growth has been 8.39%, very, very consistent. Dividend has been, awesome. It's grown every single year. If I look at the average dividend growth on this stock, it's averaged right at 10% growth, which is, again, very, very attractive. And again, keep in mind, we're going to be fixing this for you guys that don't like it. You can look at it both ways. But the problem is that the old joke that I like to tell about the definition of appreciation is when the other people appreciate what you own more than you do. And I think this stock, although normally trades at a premium valuation of around 20 times earnings or more, even at today's level, using that 20-ish multiple, the stock does not look cheap. That's a 28 multiple, which is not realistic. I'd want to adjust this down more to the 20 multiple, which is more, or 22 multiple even, which is more normal. And this just makes the stock look excessively expensive. Great company. This is exactly the kind of operating picture I look for, but I'm not willing to pay that price. Medical Property Trust is another healthcare REIT. This is one that I do like very much. I think it's trading at an exceptional valuation relative to its FFO. Offers a 6.43% dividend yield. Good solid healthcare REIT, double P plus rated, but REITs, tend to be that way for a lot of reasons. They don't necessarily have real high credit ratings because they're constantly in the market. Micron Technology is a very interesting tech stock. It's had, I'm not calculating growth here because I got negative numbers. If I look at growth, going back since like 2007 or so, it's been growing at about 19 or 20%. Expected to grow faster than that going forward. Long-term growth is over 25%. So if you're a growth stock investor and can identify the fact that there is cyclicality in the operating results of the company, this one looks extremely strong until you look at it from a price to sales point of view. And then, sales have been growing at about 10% a year, 9.93. It does look a little expensive that way. But again, you want to run these stocks through all these fundamental metrics to try to determine what kind of company it is, the nature of the beast, and how the market likes to typically value it. Annaly Capital Management, I often talk about these stocks because when you're looking at mortgage REITs, you can be very well enticed by a 13.5% dividend yield, a low valuation, 5 times earnings. But if you look at the stock historically, you can see that back in November or January 11th of 2008, the stock was trading at $18 a share. It's now trading at $6.51 a share. If you look at the performance over this time frame, you can see it's lost over half of its value. Because it did throw off such a staggering amount of income, it did generate a positive rate of return. But I don't like these guys. Now, the question is, this has been in a dropping interest rate environment. What is this company going to look like if rates continue to rise? That'll be for time to tell. I'm not sure I know, but I'm not sure I want to spend the time, looking at something like this that has been a consistent drag on your capital over all those years. Nokia has been, this is obviously a communications equipment, a tech stock, very cyclical. It's kind of done a little better here in the last couple of years, but the dividend is often cut. I just don't like investing in companies like this. They don't suit me. They're not my cup of tea. Again, I'm going through these things very fast. This is another one. I don't know a thing about this company, another communications equipment company. But, just look at the long-term results and look how cyclical they are and how unpredictable they are. You really don't know, what the earnings are going to look like. It's almost impossible to figure that out from what I see by just looking at it here. So I would tend to pass on companies like this. People's Bank, this is a decent little bank. It's had some operating issues here and there. Offers a decent yield. It's inexpensive now. Again, the question would be, what are the earnings growth going to look like going forward? And why is it, I'd be asking questions, why is it so cyclical when many, many banks, tend to be very predictable? So you'd want to find out. Here's Seal Limited, interactive home entertainment. Here I'd want to go in to the external links and try to figure out what this company did. Okay, and it's a global consumer internet company, what their values are, what their products and services are. We got obviously Shopee and C Money, et cetera, et cetera. So you'd want to learn a lot about that. But if you look at this one again, sales for these young new companies are often the best way to look at these. But you got to be careful again. A company selling at almost 9 times sales is very, very rare and very, very real. And this company got crazy overvalued. And when the market was doing this, you couldn't tell people this was a bad investment. I tried with stocks, this one and others, but look at the correction now that's happened. I mean, just this correction from this period of time right here is 94% annualized loss over this, short period of time. This has been less than a year, but you can see how dramatic the results can be when you get into, massive, valuations like this. I want to look at Shimano. I'm not really familiar with this company either. Look at it from a standpoint of adjusted operating earnings. I don't have it. Look at it from a standpoint of operating cash flow. It looks fairly decent. Leisure Products, again, I'd want to learn more about this company, but there's a lot about this company that's really hard to evaluate looking at its historical results. But again, you get a pretty clear picture there. It's interesting that there are no real analysts wanting to give any forecast on this company. That's something I'd also take into consideration. Stellantis, this is the old merger, I guess, between Fiat and Chrysler, I guess it was. This is a very interesting car company. Like most car companies, they don't consistently grow their business. This one is going to be going into the electrifying market, quite a bit. So it does, offer some intrigue. It's certainly trading at a very low valuation and has a currently very high dividend yield. So that, that could be something that mitigates the risk of, the cyclicality you see with the stock. But again, know the nature of the beast and recognize, the valuation. Toyota, probably one of the best managed automotive manufacturers in the world. But even there, you can see a lot of consistency, a lot of, dividend cuts. So it's really hard to depend on those. It's hard to make money in the automobile industry, notwithstanding Tesla, if you're looking, at that. Here's Dentsply, Sirona, healthcare supplies. Been a kind of a consistently highly valued stock, but since COVID, you can see the volatility has really increased dramatically. It does look reasonably priced today if you're interested in that, but it doesn't have a great growth story ahead of it, 5 or 6%. So again, don't get enamored with what the past was. Look at what the future is. Zimmer Biometric, another one, very similar. You can see the relationship between price and earnings. Of course, COVID kind of apparently impacted it here. BBB rated company trading at 18 times earnings. I would consider that very expensive, and without the consistency that a lot of the stocks, in the market have, I'm not sure I'd be interested in this one. Anyway, there you have it. This has been Chuck Carnevale. I've gone through like 30 names here. I did it very briefly. This is the subscriber request. These are the kind of companies you're looking at that you wanted to see. I hope I gave you some insights into some of them. Some of them you might disagree with my analysis or my logic. There's some real screaming values and bargains from a speculator's point of view in this group. But I didn't see a whole lot of what I would call really high quality value. And as Mr. Valuation, that's important to me. Anyway, it's been Chuck Carnevale saying thanks for watching. There's been another subscriber request Tuesday. These are stocks you asked to see. I hope you enjoyed it. If you did, give me a like, ring the bell, subscribe to the channel. And, you can see how beneficial Fast Graphs is when you're looking at diverse companies like we covered in this video, how it can really give you insights that you don't get just from looking at stock prices. Anyway, thanks for watching.